All right, and then I'll just need to get this from you. Hey, everybody, welcome to the Sense of Things. And today is one of our specialty shows where we bring an expert on who can talk a little bit about a topic. And our expert of the day is my friend, Roy Snarr. Roy and I have known each other for years. We literally met, and it was like we've known each other our entire lives. Yeah. And he is a recognized expert on long-term care and Social Security. He does a lot of work in the community with people that are getting close to retirement and are starting to look at those things like Social Security, how they're going to generate income, and especially how they're going to handle long-term care and deal with that as they get older. Roy, welcome to the show, brother.
Hey, Jeff, glad to be here. I always have fun hanging out with you.
I know, man. It was great catching up and having a few minutes ahead of time. So I think this is a topic that a lot of people have concern about, but they don't necessarily pursue it as much as they should in a lot of these cases. Can we start to talk a little bit about really what is long-term care and why somebody should start to really think about it and when?
Yeah, I mean, it's one of those topics where nobody really wants to think about it. It's much more fun planning your vacation out or even a grocery list, because long-term care, it's great. I have to think about something that might not happen to me. And even if it does, it's not very fun. Somebody's going to be changing my diapers or I'm going to be debilitated. I just rather push it off and push it off. And that's generally what happens. But the importance of it, if you look at the numbers, roughly 70% of people are going to be subject to some form of need in long-term care. Yeah. And when that does happen, what a lot of people don't know is that Medicare doesn't cover it. It does not cover anything for custodial care. So there's a huge financial gap, and people are forced to spin down their assets or sell off property just to pay for this unfortunate event due to our healthcare system not providing anything.
So when you think about that, what kind of let's say an out-of-pocket impact is somebody that doesn't have some form of insurance in this case? What kind of an outflow are they looking at typically?
Yeah, so even today, in today's dollars, which things are only getting more expensive as we know, but the average cost of care is about $7,500 a month here in the Central Texas region. Okay. And the way I relate it is kind of like hotel shopping. You can get the Motel 1 in East Austin, or you can get the Ritz-Carlton. Most people are like, I don't want Motel 1 and I don't need the Ritz-Carlton, but what about something in the middle, like a Holiday Inn? And that $7,500 price point is your Holiday Inn. It's right in the middle. There are some potentially less expensive services depending on the need. There's also some more expensive services, but $7,500 today, if somebody is turning 65, they won't generally need care until roughly the age of 80. So in 15 years, that $7,500 is projected to more than double. So think of it this way: husband and wife, $15,000 a month being withdrawn from the portfolio or other strains of assets. That's a huge amount of money. That's $30,000 a month. And if you run that in a software modeling program, they could quickly outlive their assets.
Absolutely. When somebody's thinking about this, when should they start thinking about long-term care? Is it I'm 40 today, or is it I'm 70 or 80? When should I think about it?
It's kind of like the old adage, when's the best time to plant a tree? 20 years ago and then today. Yeah. So there are different planning tools depending on the age. So somebody who is 40 years old, generally they're going to need a higher level of life insurance coverage than they would long-term care. So there's options that they could blend the two together. So this way they're maximizing their dollar, because there's only 100 pennies in a dollar, and we want to balance the budget out. If somebody's a little bit older, say in their 50s, mid 50s, all the way up through age 85 is where we can help people. We're looking at more of a long-term care focus. So those dollars going into the insurance policy are going to provide a higher leverage for the purposes of care than they are the life insurance itself. But the important part is to start the planning as soon as possible, because the younger and healthier that you are to enter into these programs, the greater the leverage ratio that you have in the future.
Yeah. And that's a different thought process than we used to have. Yeah. Because we used to, I know when I was actively doing this, we'd say, don't think about it until you're in your 50s. Now there's ways that you can do it a lot earlier on And there may be ways that you can average that cost out a little bit more over time, correct?
Yeah, that's exactly, because a lot of these companies, they offer different modes of premium. You can lump sum it, you can lump sum and pay, you can just pay over the course of time. So the younger you are, the longer your time horizon. An easy way to think of it is I can get a 5-year arm on my mortgage and on a 10-year note, just pay that thing off in 5 years. Or I can get a 30-year mortgage. So my payment's a lot lower. I'm living in my payment and I still own the asset. So you can design it that way too, because long-term care policy is a separate asset class. It's an actual asset class that you can own. So you can stretch the payments out longer. And the younger that you are, the bigger your time horizon is, hence lower the premium payments. And once you own it, the best part is it's guaranteed. They can't change their mind as an insurance company. So if your health changes in the future, you still have that. And that's the biggest key. Is people will ask me all the time, I'm going to wait till next year, or I'm going to wait till I retire. I'll wait till I get Medicare, or there's some kind of delayed effect in waiting. Number one, if you're interested in owning it, now is the time to get it. Don't delay. Not because the premiums will increase, because they will, but more importantly, a health event may occur to you, which could permanently disqualify you from a lot of these programs.
Absolutely. So let's talk a little bit about that long-term care process, or the care element. So what triggers the ability to use these type of policies?
Okay, great. So they're all established by the same HIPAA guidelines. If you're unable to perform 2 of the 6 daily living activities, right? Eating, bathing, going to the bathroom, need somebody's an arm's distance, you need help transferring from one room to the other, et cetera. If you do 2 out of those 6 daily living activities, then they say you're eligible for long-term care. You just get a doctor's note. The insurance company reviews the information from the doctor, make sure your doctor is not just your friend and you're trying to get money. And then they go ahead and they pay out the claim. The other triggering factor is the onset of a cognitive impairment, Alzheimer's or dementia. So if you're diagnosed with Alzheimer's or dementia and you're needing of assistance, then that can also trigger the policy.
Got it. So does this mean for me, okay, I buy this policy, so now all of a sudden I have these issues.
Yeah.
Am I going to a facility at that point?
So it's up to you. A lot of the older policies, that's how it was. Like they would only pay out in a facility. And even in today's marketplace, there's some shorter term policies like short-term home healthcare. They only pay for home. There's nursing home specific policies that only pay for a nursing home. We're a bigger fan of the broader picture where you have the flexibility as the consumer to choose to receive care at home or to receive care in a facility. And a step above that, which was not available a number of years ago, are long-term care policies that are indemnified, meaning that once you are eligible for claim money, you can spend the money however you choose. Your family could push you around in a wheelchair in Vegas. They don't care. It's just a health trigger that gives you the cash that's tax-free indemnified. There's also more of the traditional policies where they don't have that feature. They reimburse you for qualified long-term care expenses, either at home or in a facility.
Okay. So like at-home care, I mean, that's not just providing for services, but that can be bringing in somebody to help and all that kind of stuff as well, correct?
That's correct. So depending on the type of policy, if it's a reimbursement policy, you can't just pay a family member unless they are part of a certified agency, right? They want certified type of care being given. If it's an indemnity-based policy, then you can pay your gardener, your neighbor, your friend, your kids, your grandkids, whoever. They don't care where you spend the monies at. But yeah, it is flexible. Like all the policies today, they give you the option: nursing home, adult day, assisted living, at home, wherever you want to receive care. There's even policies that we help people with that are internationally. So what I mean by that is if you want to retire in a foreign country, you can receive payment indemnified to you in USD and spend that money overseas, say in Thailand, Vietnam, China, India. There's no restrictions.
Yeah, and it stretches your dollar too. You become
big time.
a smarter consumer in those cases.
Oh, yeah. It's more popular today than it used to be. People wanting to move overseas. Like we have a lot of clients that say, hey, we're going to move to Mexico and Acapulco or wherever. And if you need full-time care in Mexico, you could get really quality service, even today's dollars, for $2,000 a month. That would be like top shelf.
Yeah.
Versus here, top shelf is like 12 to 15,000 a month, right? So your dollars go further. So that's a goal of yours. You want to be intentional about that goal. And we design the long-term care around that. That way you can actually utilize the policy if indeed you decide to go overseas.
Absolutely. That's fantastic. Can we talk a little bit now about the types of policies that there are? Because the traditional way that people thought of it was, I just buy insurance and I just pay along the way and all that. Can you talk about the different types of policies that are out there now? I know we've talked a little bit about this.
Yeah. So in a nutshell here, there's really two ways to own long-term care insurance. You can have the traditional long-term care insurance, which is classified. There's a tax code, everything. There's state partnerships. There's some details to that, but simplicity, it's a long-term care policy that you pay monthly or annually for. If you die, there's generally no return of premium or death benefit. If you need to use it, you have to use it for care. And when they do pay it out, it's reimbursement. It's not indemnity. But the biggest risk to traditional long-term care, which it is better priced today, is the fact that the premiums can increase over time. So somebody who's comfortable with it today, in 10 years from now, it could be exorbitantly more expensive. For instance, we had a carrier send out a letter to one of the clients we're working with, and we did not help them with this policy. They had bought it prior, but it was a 630% increase in premium in 1 year. So think about it. You're doing the right thing. You're paying your bill on time. You're doing everything right. All of a sudden you get a letter saying, hey, we're going to increase the premium. Oh, and by the way, if you don't want to pay the premium, that's okay. We can give you an option to slice your benefit in half or whatever it may be.
Yeah.
We try to avoid those because they may be initially less expensive, but the reality is that the insurance company can increase it. And if an insurance company has the ability to do so to make more money, generally they will. So we like the other side of the long-term care aisle, which is asset-based long-term care. It utilizes either an annuity chassis or a life insurance chassis. The difference is the money's inside of the life insurance chassis is not designed to give you a whole bunch of death benefit, but rather it's designed to give you as much long-term care as possible. And the same thing with the annuity side. It's not designed to give you lifetime income or good growth. It's designed to give you as much leverage as possible for the purposes of long-term care. So those are the main avenues we help folks with. And if budgeting is an issue or health, there are even options today that have guaranteed issue long-term care policies. They can also do like more of a shorter term, so less than a year, like a nursing home or a short-term home healthcare, $50 a month. Tons of options out there for folks.
Yeah. And so what I would say is you want to find somebody like yourself that understands all the options that are available, that can sit down and do some planning. And I think from a financial planning perspective, this is a component of a financial plan. So when I'm working with a client and doing a financial plan for them and building a strategy, I'm thinking about, okay, well, let's bring in somebody that you and I can work together to really put the plan together and make sure that we're fitting that into their budget, make sure that we're covering all the potential things that could hurt them down the road.
Exactly. And a lot of people, they say, I'm going to self-insure. You're still self-insuring with insurance because they're not just going to give you a free policy because you're a nice guy. So the way we explain it to people, you have two types of self-insuring. One, you could spend your own money dollar for dollar, create no leverage, create no tax advantage. Or two, you can place your money with an insurance company. You can always get your money back. If you pass away, they give it back to your family if you never use it. It could be 100% liquid. And if you happen to need care, then every dollar that you put in, they're going to match out of their pocket up to 3, 5, or even 10 times the amount that you placed in there, depending on when you started it, all tax-free. Yeah. That's how you create leverage. It's just, if your house was paid off, most people would still have a homeowner's policy.
Yeah.
But you don't have to. You don't have to have homeowner's insurance if your house is paid off. That insurance is designed to protect the lender. But people still have that. And you have to ask yourself, is it more likely that I'll fall into the statistical likelihood of 70% of needing care, or that my house is going to burn to the ground? So it's just a difference of mindset.
Yeah. Can you talk a little bit to how some of the state partnership programs work?
Sure.
When it comes to long-term care?
Yeah. So the state partnership programs are applicable with traditional long-term care. Okay. They are not applicable with the asset-based model. And the reason why, again, we like asset-based model is because you get more leverage and everything is guaranteed. They even have guaranteed level premiums throughout the whole thing. But on the state partnership side, basically the way it works is it helps you with Medicaid qualification. Because if you don't have any money, any assets, the state will pay for it for you through Medicaid. Now, even in Texas, it can take 3, 4, 5, 6 months to get approved. And there are attorneys that help you get approved for it. And they have a 5-year look back on your assets. And it's pretty challenging to qualify for Medicaid if you have any other sources of income other than Social Security. It can be very difficult. Now, what they do is, let's say that you had a $300,000 pool of long-term care benefit with a traditional policy, and it's part of the state partnership program. That $300,000 coming in to pay you monthly for care is not going to count towards your income and Medicaid qualifications. But if you have an asset-based policy paying the same thing, it will count against you towards Medicaid, and it could disqualify you from Medicaid. But it's not that challenging to make the decision, because if you are in a position where asset-based long-term care is applicable to you, you're not going to have a Medicaid problem. You already have too many other assets. And I always encourage people, just Google whatever state you're in, Medicaid qualifications. You'll go, wow, if I have $10,000 in cash value life insurance and $3,000 a month coming in, I don't even qualify. It's amazing like how low you have to be in order to qualify for the state's program. And if you're not careful, after you pass away, the state will courteously go back and audit your entire estate to make sure that you indeed were eligible for the last 5 years of benefit being paid. It's absolutely crazy on how they do that.
It's just so nice of them to do that. We truly appreciate them for being so diligent. Yeah.
Yep, exactly.
So if you had to, I meant to ask this question at the beginning.
Sure.
You're a young guy. What made you get interested in long-term care? Why did you get involved with it so much?
Well, it's every young boy's dream to grow up and sell insurance.
It's true. I can see that.
But I developed my passion through experience. So my mother, when I was about 14 years old, became permanently disabled. Somebody ran a stop sign, bam, sideswiped her. And that led to degenerative disc disease being accelerated. We lost absolutely everything, had to move. It was very traumatic. I was only 14, so I didn't really know what was going on in the world. And I had this passion, like, man, I want to be able to help people prevent this situation. And during that time frame, shortly after the accident, we experienced 3 different long-term care events. The fourth one was a little bit later, where my mother's mother needed care, my father's mother needed care, and then my mother's dad needed care. All in this time frame, and they needed care for years. And so not only was she disabled, we're trying to figure things out financially, things were tough. We're trying to take care of the grandparents and trying to help everybody out. I'm like, my goodness, like what little bit of assets that they had all spent down on care. This is absolutely insane. Why didn't anybody talk to them? They had financial advisors and all these other people, but nobody had that conversation with them. And that's the challenge. Most people aren't even asked. So when I come to help people, I come from a place of knowing. And so I have total empathy with folks that have gone through it, or they're about to go through it with a loved one, and to try to help prepare them. Look, I've been through this, and I have thousands of clients all over the country that have protection and stories of their own that I've heard. And so this is why it's very important to have some level of protection within the portfolio. And that's how I became passionate about this. And fortunately, there's not too many people that are asset protection specialists. And we've been able to become #1 in Texas. We're in the top 10 in the US. So we help thousands of people every year. So it's very rewarding as well to know that we're placing in tens of millions of dollars in coverage every year for people. So that when that time comes, if it comes for them, they're taken care of.
That is brilliant. Brother, I appreciate you being on today and sharing all your knowledge. Just great stuff, as always. It's why we've hung out together for a long time and worked together for a long time, because you've got both in your heart plus in the knowledge side of it. So that makes it even better. So folks, thank you for joining us today. Roy, if somebody needed to get a hold of you, what's the best way?
The best way, you could simply type my name into the Google bar, the Roy Snarr, Snarr. I'm all over the internet. And if somebody wants a free copy of our long-term care book, it's actually became a bestseller. We have people buying it in Germany, all over the world. It's a very simple manual. It's only 88 pages. But if you read that book and you still don't see the need for long-term care, can't help you. But whether you work through us, we work in multiple states, or you already have a trusted advisor that you're going through who has brought this to your attention, revisit them or reach out to us. Let us at least show you the options. Get the book. It's free. Just message me and I'll mail you a copy.
Beautiful. Thank you. And we'll put the connection to you in the show notes as well. So just look below here and do that. So folks, thank you for joining us today. And we do these on a regular basis, but not every week. So make sure that you hit that subscribe button and that little bell notification button on the YouTube channel, and that will give you an update as soon as we put any of these up. So thank you, Roy. Appreciate you being on today. And folks, thank you. And we will see you back here the very next time.